Tuesday turned into a pretty busy day, actually. The UMBS 5.5 were down 16 basis points to start the day. Bonds had mixed overnight session, holding flat in Asia, rallying into European hours and selling back to unchanged after the EU PMI data came out slightly stronger. The opening few minutes of domestic session saw a brief stint of buying right after the open, but those gains were quickly erased after the Philly Fed data. The January Philadelphia Fed non-manufacturing index rose to negative 6.5. Yes, I said it rose to a negative number. This gauge of regional business activity was negative 12.8 in December. New orders rose to 10.8 from negative 2.1, and inventories rose to 6.5 from negative 2.6. The private sector continues to contract according to the Flash PMI index. The U.S. economy has started 2023 with a disappointingly soft note, with business activity contracting sharply again in January, although moderating compared to December. The rate of decline is amongst the steepest seen since the global financial crisis, reflecting falling activity across both manufacturing and services. The worry is that not only has the survey indicated a downturn in economic activity to start the year, but the rate of input cost inflation has accelerated into the new year, linked in part to upward wage pressures, which could encourage further aggressive tightening to Fed monetary policy. So this is one of those news items where bad news is good news because we have to have this happen in order to stifle inflation. About 13% of adults plan on buying a new home, a decrease from 15% in the third quarter of 2022, according to research from the National Association of Home Builders. Respondents are more interested in buying an existing home than a new one. The yield curve remains super inverted. The 1 month is 106 basis points below the 10-year. The 3 month is 120 basis points below the 10-year. The 1 year is 119 basis points below the 10-year, and the 2 year is 72 basis points below the 10-year. This is a very strong indicator of recession coming. Bonds took several opportunities to react to economic reports that don't typically merit much reaction today. We saw similar behavior early in January. It made good sense at a time when the markets were extra hungry for every tidbit of economic guidance. After all, everyone is waiting to see if inflation is really defeated, and the soft landing might be from the Fed's inflation tightening efforts. I need to give up hope of that. If you ask me, buyers are ultimately ready to buy as soon as data-driven selling pushed yields back to yesterday's high. So at the end of the day, we ended up being at 101.34. So 101.34, which puts us right underneath that 38.2% Fibonacci line, and in an ever-tightening range with four different lines converging as a floor. Also got data that loans and forbearance were flat at 0.7% according to the MBA. Fannie and Freddie loans were at 0.31%, and Ginnie loans were 1.35%. So you look at that and you say Ginnie loans at 1.45% is still really low, but it's important to note that it's almost 5 times that of Fannie Freddie loans, which impacts the bond market and servicing values. We also got a post from our sponsor at WellThatMakesSense.com from Traction. So if you have goals that are important to you this year, which you should have, check out these posts on Traction, because Traction is the best operating system for setting up your year to achieve those goals.